IBM falling further this morning after it cut revenue guidance for the rest of the year. The company also posted misses on the top and bottom line for the second quarter, which follows a record 25% single-day drop, remember, last week after IBM issued a warning to investors ahead of yesterday's earnings report. Joining us to talk about all of this, including a new quantum deal that was announced today. First on CNBC, IBM CEO Arvind Krishna. Arvind, welcome back. It's good to have you.
Good to be with you, Sarah.
Okay, so let's get into all of this because, people took your warning last week and then the subsequent earnings that you reported last night as a sign that you are no longer immune to AI and that your software business is at risk as enterprises spend more and more money and time building out their AI. Can you just clear up what actually is happening here?
So actually, I don't think that that's quite accurate. I think there is a second-order effect. Because of the semiconductor boom, which you just had Ben talk about, the prices for a lot of infrastructure components has gone way up. As people spend more money on that, they're choosing to prioritize that because of their fear that 6 months from now, it'll be even more expensive. As they prioritize that, we saw a few tens of large CapEx deals move out of the quarter. Now, the good news is about a third of them have already come back. So that tells us that in 3 weeks, we recovered about a third of them. I would not expect that we'll recover all of them, but we will do some. So it's the CapEx piece that impacted our miss in the second quarter, not really the direct spending on AI. That actually will turn out to be a boon for us, or a tailwind, not a headwind.
Why? Can you explain why it's a tailwind for you and not a headwind? Because we've seen it be a headwind for other software companies.
So we have very little. About 2% of our software falls into the category which I'll say could be easily replaced with a new application built on AI, be it an AI agent or be it a direct use of a model. That 2%, I think, will likely get impacted. However, the rest of our software really helps people get ready for AI, unlocking data in real time, reducing the cost and complexity of managing it, going across the hybrid infrastructure, which most of our clients are using. And because it would be what you would call maybe infrastructure software, not applications, I believe it'll be a tailwind for us. The other part, which I really believe strongly in, I believe there will be a very big use of the large foundation models hosted on some cloud infrastructure. And there will be a big use of open weight models that are already hitting more than 50% of all token usage. And the third one, which is yet to come in, is models at the edge and on premise. And as people need to then straddle those environments, I think we're incredibly well placed to help our clients across those.
So is the 2% you say that's vulnerable, is that where the Starbucks story comes in? Because that didn't help matters, sentiment around the stock, when there are reports that Starbucks is sort of ditching your software to build its own AI system instead.
So Starbucks is a little over $2 million a year software client for us. The piece that they are taking out is from a real estate lease management software called Tririga. That is a big component of that 2% I talked about. And I do think that software like that is subject to risk. By the way, what they had in place was a 10-year-old piece of software that had not really been upgraded in the previous 10 years. That said, actually, I think Starbucks could actually be a larger client of pieces from our HashiCorp portfolio and in the future our Confluent portfolio. So the older piece, which is replaceable, may go. But I'm optimistic that we'll get other business from Starbucks, but I also quantified the size of their business with IBM.